Okay, sorry for that. So today we are welcome everyone, welcome to EduTap, and today we are going to discuss the Monetary Policy Committee meeting that has recently happened, and we are going to discuss the changes and the updates that has been brought by the Monetary Policy Committee. Okay, so the Monetary Policy Committee, we are going to discuss the updates, and this is very important from your descriptive answer point of view, your objective answer point of view. So the MPC has MPC has been reconstituted, so we are going to discuss about that also. And this whole news article is very, very important from your examination perspective. So I hope you will give focus on this news article. Okay. So let's start with the session, and the PDF of this session you will get in your Telegram channel, in the Telegram channel of EduTap, and the link for the Telegram channel is provided in the description box below. So now we are going to start with the reconstitution of the RBI MPC. Okay. So now the reconstitution of the MPC, the Monetary Policy Committee, has happened with 3 new members. So there is the reconstitution of RBI Monetary Policy Committee with 3 new members. The government has appointed Ram Singh, Sogata Bhattacharya, Nagesh Kumar as external members of MPC. So are you aware that how many members the MPC has? The Monetary Policy Committee has how many members? Anyone is aware about this? In total, there are 6 members of MPC. There are 6 members of MPC. Okay. So now out of these 6 members, the 3 members are from the Reserve Bank of India, including the RBI governor. And the other 3 members, they are the external members that are appointed by the government of India. They are appointed by the central government. So the 3 external members, they have been changed, we can say, or there is the new appointment of the 3 external members, that is Ram Singh, Sogata Bhattacharya, and Nagesh Kumar. So these are the 3 new members of the MPC. The other 3 members, they are from the RBI itself. Shaktikanta Das, who is the governor of the Reserve Bank of India, deputy governor of RBI, as well as one officer of RBI nominated by the central board. So there are 3 members that are from the RBI, and these 3 members from the RBI is the governor of Reserve Bank of India, who is Shaktikanta Das, deputy governor of the Reserve Bank of India, who is Michael Debatra Patra, and there is also one officer of RBI that is nominated by the central board, that is executive director right now, the executive director Monetary Policy Department of RBI, that is Rajiv Ranjan. Okay, so these are the these are the 6 members now, 3 external members as well as 3 members of the RBI. So this is the whole idea. Now the extended tenure. Now for Shaktikanta Das as well as for the Michael Debatra Patra, for these 2. So extended tenure of the 2 ex officio members, the governor Shaktikanta Das and the deputy governor Michael Debatra Patra, they have the extended tenure. Their tenure was extended. Okay. So now these extended tenures, they are also going to come to an end in December 2024, in January 2025 respectively. So this is the reconstitution that has happened. 3 new members have been appointed by the government of India. They are the external members of the Monetary Policy Committee. Now apart from this, there are 3 members of the MPC that are from the RBI itself. One is your governor of the Reserve Bank of India, who is currently Shaktikanta Das. The other one is the deputy governor of the Reserve Bank of India, who is the deputy governor, who is the Michael Debatra Patra, and one officer of the Reserve Bank of India that is nominated by the central board, that is the Rajiv Ranjan. Okay, so there are the 6 members. Now a selection panel. How these 3 new members are selected? Are they selected by the Prime Minister? Are they selected by a special committee or such? So a selection panel comprising of RBI Governor Shaktikanta Das, Cabinet Secretary TV Somnathan, and the Economic Affairs Secretary Ajay Seth. So they are responsible for choosing the external members of MPC. So a selection panel sits, that is comprising of RBI Governor, Cabinet Secretary, and Economic Affairs Secretary. So they there is a panel, selection panel that sits, and they are responsible for choosing the external member of the Monetary Policy Committee, and the final approval for these position lies with the Prime Minister's office under Narendra Modi, who is the Prime Minister of our country currently. So I hope you understand that even in the choosing of these external members also, even in the choosing of these 3 new members, there is still the role of the governor of the Reserve Bank of India. Okay. So before, in the last Monetary Policy Committee, these were the members of the Monetary Policy Committee. Okay, now the external members Shashanka Bhire, Ashima Goyal and Jayant R. Verma, they have been replaced with Nagesh Kumar, Sogata Bhattacharya and Ram Singh. These are the 3 new members that have given their, they have sat for the new Monetary Policy Committee meeting. So in the previous Monetary Policy Committee meeting, there were the older members of the MPC. Now in the new Monetary Policy Committee meeting that has happened in October, that has just finished on 9th October, the Monetary Policy Committee finished, and in this Monetary Policy Committee, the recent Monetary Policy Committee, for that there were the new members that sat for the Monetary Policy Committee meeting. Okay, so this is the idea. Now coming to the Monetary Policy Statement that has been released by the Reserve Bank of India. So Monetary Policy Committee Statement, this is released by the this is given by the Monetary Policy Committee, and this is released in the press release section of the RBI website. Okay. So now monetary policy update. Today the Indian economy presents a picture of stability and strength. The balance between inflation and growth is well balanced. India's growth story remains intact and the inflation is on the declining path. So let's understand that what are the data points, and you will be able to understand that our country is doing very well in terms of growth, in terms of declining inflation, in terms of foreign exchange reserves. The country is doing very well. Okay, so let's start with the major decisions that have been taken by the Monetary Policy Committee. Till now, any confusion anyone has? So we will discuss about the neutral stance, we will discuss about the decisions that have been made by the MPC. So let's start with it. After assessing the current and evolving macroeconomic situation, the Monetary Policy Committee has decided to keep the policy repo rate under the LAF facility unchanged at 6.5%. So this is your liquidity adjustment facility. This is your liquidity adjustment facility. Under this, there is the repo rate, there is the standing deposit facility, and there is the MSF, marginal standing facility rate. Okay, so repo rate is kept at unchanged at 6.5%. SDF is less than the repo rate by 0.25%. So SDF currently is 6.25%. Your MSF is higher than the repo rate by 0.25%. So MSF is your 6.75%. Okay, so this is your LAF corridor, this is your liquidity adjustment facility corridor. SDF is the deposit rate of the RBI. This is the rate at which RBI takes the deposit from the banks. Repo rate and MSF, they are the lending rates of the RBI at which the RBI lends to the banks. Repo rate is the lending rate in the general situation. MSF is the penal rate of lending. When the banks need extra lending, then they take the lending under the, when the banks need extra money because of the liquidity shock or because of the liquidity crunch, so they take the money under the MSF. Okay, so these are the rates that have been kept at this level. Okay, now coming to the next point, that is the very interesting point, that the MPC till now, from previous many of the MPC meetings and till in the previous many of the MPC statements, the MPC was keeping its stance at withdrawal of accommodation. Withdrawal of accommodation means that the MPC is either going to keep the repo rate unchanged at the higher percent, that is 6.5%, or the MPC can decrease the, or the MPC can increase the repo rate, or the MPC can increase the repo rate. Okay, or the MPC can increase the repo rate. So withdrawal of accommodation means that the RBI Monetary Policy Committee has said in the previous many of the meetings that we are withdrawing the accommodation, we are going to keep the repo rate at the higher percentage, we are going to keep the repo rate unchanged at this high percentage, or we are going to increase the repo rate in the coming meetings. Okay, so this is withdrawal of accommodation, that there is no chance of decreasing the repo rate. There is no chance of decreasing the repo rate, because if we decrease the repo rate, that means the interest rate will decrease in the economy. The interest rate can decrease in the economy, and with the lesser interest, there will be more loans that will be taken. There will be more money that will be supplying in the economy. As people take more loans, they will demand more and prices will start increasing. The inflation will expand. So RBI said that in no circumstances we are going to decrease the repo rate. We are not going to do so. Okay, so that's why the MPC in its previous meetings was saying that we are going to keep at the withdrawal of accommodation, that we are like in the coming MPCs, we are not going to decrease the repo rate. Okay, that is withdrawal of accommodation, that in any scenario we are not going to decrease the repo rate. But in this October Monetary Policy Committee meeting, the MPC has changed its stance. Now the MPC is saying that rather than withdrawal of accommodation, we are at a neutral place. We are at a neutral place. We are taking the neutral stance. What is the meaning of neutral stance? Neutral stance means that the MPC can keep the repo rate unchanged in the coming MPC meetings, or the MPC can increase the repo rate, or the MPC can decrease the repo rate. So in the neutral stance, it says that on the basis of the evolving situation of the economy, the MPC can decide to even reduce the repo rate. Because why this neutral stance has been taken? Because the MPC is saying that currently we are at a we are having a good balance of growth and inflation. The inflation is reducing, disinflation is happening. Disinflation is happening means that inflation rate is reducing to a great extent, to a good extent, okay, and there is a balance between growth and inflation that we are meeting. So that's why the MPC also decided to change the monetary policy stance from withdrawal of accommodation to neutral. Neutral means that the MPC in its coming meeting can keep the repo rate unchanged, or can decrease the repo rate, or can increase the repo rate. And to remain unambiguously, that is to remain certainly focused on a durable alignment of inflation with the target. So inflation target is 4%. The inflation should be around 4%, within the range of plus minus 2%, within the range of 2% and 6%. So the lower tolerance level is 2% and the upper tolerance level is 6%. I hope this is clear. Any confusion, anyone? Kindly inform me if there is any confusion. So neutral stance is a balanced approach where the central bank perceives that both inflation and growth are relatively stable. They are having good balance of inflation and growth. Under this policy, the future interest rate decisions depend on the evolving macroeconomic conditions without any predetermined direction. So in withdrawal of accommodation, there was a predetermined direction that either it will remain unchanged, either the repo rate will remain unchanged, or it can be increased. But in the neutral policy, there is no predetermined direction. It can increase, it can decrease, it can remain unchanged. Okay, so this is the idea. Any confusion, anyone? So the decisions that have been taken to keep the to change the monetary policy stance to neutral, or to keep the repo rate unchanged at high percentage, that is 6.5% of repo rate. So these decisions are in consonance with the objective of achieving the medium term target for consumer price index inflation. So inflation that we say is our retail inflation, the headline inflation, the CPI inflation. So CPI inflation is the inflation that affect the consumers. It is the consumer price index inflation. That is the inflation that is affecting the consumers. So the target for that is that the inflation should be around 4% within the range of plus minus 2%. All clear? Is it only clear to Shorish? What about the others? So this is the history, we can say, that from till the February, till the Feb 2023, there was the rate hikes that were happening. There was the increase in rates that were happening. But after that, the last rate hike happened in February 2023. After that, there was the unchanged repo rate. The repo rate was kept unchanged. Okay, so the last rate hike happened in February 2023, and after that, the repo rate has been kept unchanged. Clear, everyone? Nice. Now moving forward, what is the growth and inflation outlook that has been given by the Monetary Policy Committee? So domestic economic activity continues to sustain its momentum. So domestic activities are having the momentum. After a weak and delayed start, the cumulative southwest monsoon rainfall has picked up. So monsoon rainfall is good, and with improving spatial spread. So the monsoon is having the spatial spread. It is having the spread in the country. Okay, by August 7, 2024, it was 7% above the long period average. So the monsoon was good and it has picked up its pace. The agriculture sector is expected to perform well on the back of above normal monsoon and robust reservoir levels. So the reservoir levels are also good. Manufacturing and services activities have remained steady. On the demand side, there is the healthy Kharif sowing that has happened in the monsoon season, coupled with sustained momentum in consumer spending in the festival season. So as the festival season is going on, and with the Dashera, with the Diwali coming, there is more of the consumer spending that is happening. There is like sales that are going on and such. So this festival season is there, and there is the increase in the consumer spending that has happened, that is further boosting the demand and boosting the production in the country. This augur will for private consumption. Consumer and business confidence has improved in the country. External demand is expected to get support from improving global trade volumes. So with the global economy having the stability again, there is the external demand that is also rising. Okay. Healthy balance sheets of banks and corporates, the government's continued thrust on infrastructure spending. So all the sectors are performing very well in the country. Real GDP growth for 2024-25 is projected. So on the basis of all these circumstances, or on the basis of all these factors, the real GDP growth for 2024-25 is projected at 7.2%, and for the quarter 1 of 2025-26, there is the expectation of the real GDP growth at 7.3%. Okay. So these are the data that you can remember. The quarterly data of 2024-25 is not very important. Just have a read. Okay. Next, coming to inflation. So we have understood about growth. So growth is having there is good growth in our country. Now coming to inflation. So now here, seeing this, you will be quite surprised and happy that the headline inflation, the retail inflation, declined sharply to 3.6% and 3.7% in July and August. That means we have came very near to 4%, and even below, the inflation is going below the 4% mark. So that is a good disinflation that we have seen. The inflation rate has decreased from 5.1% to 3.6% to 3.7%, and we have came very near to the 4% mark. So that is very, very good for our economy, that we are able to control the inflation. Okay, we are able to control the price increases. Prices are increasing, but at a healthy level of 3.3%, 3 to 4%. Okay, going forward, the September inflation print may see a significant pickup because of the base effect. So try to understand that if we are comparing 10, we are saying that the inflation has increased from 10% to 20%. How much hike we have seen? How much of the increase we have seen? Can you tell me? That if we are saying that the inflation has increased from 10% to 20%, so in between this, like how much of the increase have we seen? 50% of increase or 100% of increase? How much of the increase we have seen? That previous month in May, the inflation was 10%, but in June, the inflation is 20%. So the increase is of, isn't it of 100%? The inflation has increased by 100%, right? It has doubled. Yes. Okay. Now, let's say that in May, the inflation was higher and the inflation was not 10%, the inflation was 15%. Now the inflation has increased from 15% to 20%. Now how much of the increase has happened? Now how much of increase has happened? From 15% to 20%, how much of the increase in inflation has happened? From 15 to 20%. The increase in inflation is around 33%, right? That the inflation has increased by 5%, that is inflation has increased, like there is increase in inflation, the change in inflation is 33%, okay? The inflation has increased by 33%, like there is a 33% change that has come in the inflation. So you can see that if we have a lower base, then the same increase is by a higher percentage. Okay, so going forward, the September inflation print may see a significant pickup. So the September inflation will be seen at a higher percentage because of the base effect, because we will compare it with your July and August. So if we are comparing the September inflation, or if we are calculating the inflation in September against the August, so we will say that the inflation has increased by a lot, because in August the inflation was very low. But if inflation would have been higher, around 5%, around 4%, so in September, the increase in inflation would not have been much. So this is the basic idea, that the September inflation print may see a significant pickup as the base effect turn as adverse, because the base effect is very low, because the base that we are comparing the September against is very low, and food prices register an upturn also. So the food inflation, however, is expected to ease by quarter 4 on better Kharif arrivals. So by the quarter 4 of 2024-25, that is the last quarter of 2024-25, that is from January to March 2025. In this quarter, the Kharif arrivals will happen, and there will be, the food prices will have a upturn. The food inflation will be controlled or is expected to ease. So food inflation is expected to decrease by quarter 4 of 2024-25 on better Kharif arrivals, as the Kharif crops will be reaped, and rising prospect of good Rabi season. Now, sowing of key Kharif crops are higher than last year's and the long period average. Sufficient buffer stocks we have, adequate reservoir levels we have, the likelihood of a good winter and favorable soil moisture conditions. This augur well for ensuring that the Rabi season and the Rabi crops through adverse weather events remain a risk. So there is the good Rabi season that is coming up, but still you cannot control the natural scenarios, or you cannot control the natural events. So till now it is expected that because of the good reservoir levels, because of good likelihood of a good winter and favorable soil moisture conditions, it augurs well for the coming Rabi season, for the coming Rabi crop, though adverse weather events can happen and we do not know about that. So till now everything is looking rosy for the agriculture sector and for the crops that we are going to get, but food inflation can change rapidly in the coming months on the basis of the weather events also. So till now the food inflation is expected to ease by the quarter 4 of 2024-25 on the basis of the different scenarios. Firms polled in the Reserve Bank enterprise surveys expect input cost pressure to ease. So input cost pressures are going to ease. The input cost is going to decrease. However, the very recent upturn has been seen in key commodity prices such as the prices of metals and crude oil. This needs to be closely monitored. Okay. Next is, taking all these factors into consideration, the CPI inflation for 2024-25 is projected at 4.5%. So this is the basic idea. Okay. So this is the percentages. The repo rate has been kept unchanged at 6.50%. So your SDF rate is kept unchanged at 6.25%, and your MSF rate is kept unchanged at 6.75%. If MSF rate is 6.75%, that means bank rate is how much? Bank rate is how much? You must know that the bank rate is always aligned with the MSF rate. So if MSF rate is 6.75%, that means bank rate is also 6.75%. Okay. GDP projection for financial year 2024-25 is 7.2%, and inflation projection is 4.5%. Now this is the highlights of this Monetary Policy Committee. In the previous session, we have also discussed the statement on developmental and regulatory policy document, in which we have discussed the 5 important updates or proposals the Monetary Policy Committee has given. So that is regarding your UPI 123 pay limit to be increased, UPI Lite wallet limit to be increased, as well as there is also discussions about the different portals and such. So I hope you will see the previous session, because the statement on developmental and regulatory policy document is also very important. Last year there was a direct question in the descriptive part of your RBI grade B from the statement on developmental and regulatory policy document. So from this document there was a direct descriptive question in the RBI grade B last year. So this document is also very important, and now I have taken the session, just the previous session is on this document. So the members, the 4 members, the 5 members, they have voted to keep the policy repo rate unchanged at 6.50%, but Dr. Nagesh Kumar voted to reduce the policy rate by 25 basis point. All of them, all the 6 of the members, they agreed to change their stance from withdrawal of accommodation to neutral. Okay, so this is the idea. Now coming to governor's statement, there is a very important point that the governor has discussed in the governor's statement that is released after the Monetary Policy Committee meeting ended. So governor, in his statement, the RBI governor, he said that the flexible inflation targeting framework that we follow, that the inflation rate is 4%, but there is a range that is provided of plus minus 2%, that the inflation should be between this range of 2% and 6%. Okay, this is lower tolerance level, this is upper tolerance level. So inflation should be in between 2% and 6%, and inflation should be around 4%. Okay, so there is a flexible inflation targeting where the inflation rate can change within the bounds. So now the flexible inflation targeting has completed 8 years since its introduction in 2016. So it was introduced in 2016. The RBI Act of 1934 was amended in 2016 to introduce the flexible inflation targeting framework, so that it provides the RBI enough of the space to control the inflation or keep the inflation within the bounds, as well as it can also provide the flexibility to the RBI to keep in mind the objective of growth also. If the inflation is around, let's say 4%, is 4.2%, and with the growth that is happening, with the production that is increasing, with the higher and higher demand, the inflation is rising to 4.5%, 4.7%, 5%, the RBI will allow that. Because with the increase in demand that is required right now, the increase in demand is required, the increase in production is required. So the increase in demand can increase the prices, can increase the inflation, and the increase in inflation from 4% to 5% can be allowed by the RBI, because there is the range that the upper tolerance level is 6%. So there is some flexibility that is provided to the RBI to maintain the price stability while keeping in mind the objective of growth also. So this is the flexible inflation targeting framework that has completed 8 years since its introduction in 2016. The RBI Act of 1934 was amended to bring this flexible inflation targeting. Okay. Now coming to external sector. So India's current account deficit. Current account, it includes the trade in goods, the trade in services, and the transfer payments, that include the remittances that are coming from other countries and the remittances that we are providing to other countries. So current account deficit widened to 1.1% of GDP in the Q1 of 2024-25 on account of higher trade deficit that we have seen. Buoyancy, that is good services exports we have gained, and strong remittance we have gained. Okay, and these are expected to keep the current account deficit within the sustainable level. So there is the deficit that is happening, but the deficit is in the sustainable level because of the services exports and strong remittance receipts. On the external financing side, the foreign portfolio investment flows have seen a turnaround from the net outflows to net inflows, as well as the foreign direct investment flows have remained strong as well as the external commercial borrowings moderated. So external commercial borrowing that we were taking from outside, the borrowings that we were taking from other countries, that has moderated, that has decreased to an extent, and the non-resident deposits recorded higher net inflows. So there are more and more deposits of the non-residents that are coming to India. So this is, if the non-residents are depositing their money in India, is it an asset for our country or this is the liability for our country? Can anyone tell me that if the non-residents are depositing more and more money in our country, is it the asset for our country or liability for our country? So if the non-residents are depositing their money in our country, that is a liability for our country, or that is the liability for the bank, because the bank will have to return the money whenever the non-residents demand. Okay. So there is the higher net inflow that has happened. The non-residents deposits have increased. India's foreign exchange reserves. So this is a good news for our country, that we were not expecting the foreign exchange reserves to go above 600. Then we were not expecting that foreign exchange reserves will go above 650. Then at last the foreign exchange reserves have gone above $700 billion. So you can understand that India's foreign exchange reserves have already crossed a new milestone of US $700 billion. So this is a very, very good news. There was a time in 1991 where we didn't, or there was a time in late 1980s where we didn't have enough foreign exchange reserves to survive our country after 2 to 3 weeks, or to do the imports after 2 to 3 weeks. And now we have come to such a situation where we have enough of the foreign exchange reserves to sustain for months. Okay, so overall India's external sector remains resilient as key external sector vulnerability indicators continue to improve. So this is the whole idea. Yes, very good. So now I hope you will be easily able to answer this question. So this is your homework question as well as, so this is the first question, and the second question is this. I hope you will be able to answer this question. So this is also the homework question. Okay, so this is it for today. Thank you very much everyone for joining the session, and happy Dashera to everyone. I hope you will enjoy with your family and you will continue preparing with the full gist. And if you like the session, do give a like and do give a comment, as well as do give the right answer of the homework questions. Okay, so happy Dashera to everyone, as well as if you want to, like, if you have any doubts regarding any of the examination, you can go to edutap.in. So this is our website, and you can get the blogs. You can read the blogs. If you have any confusion regarding a particular examination, you can read these blogs. You can get the exam information regarding any of the examination. You can get the strategies, the success stories and such. Even if you want to know about the courses that we are providing, you can know about the courses, and you can get, like, the Shara is going on, so of course there is the maximum off that is going on, so that also you can see. You can also see and practice the PYQs. So everything has been provided in the, like, the important things have been provided in the website. So you can go and see the website also and see the blog section. And happy Dashera everyone. I hope you will enjoy, as well as keep on studying. The examination is just around the corner, so enjoy as well as study. Okay, so thank you everyone. Thank you for joining the session, and see you now. There will be no session of Finance 360, as I'm going to take a marathon session on 16th of your October, 16th of October. So on 16th of October, I will take a marathon session of yours. So in that marathon session, we will discuss the important topics, as well as we will revise the important topics. Okay. So on 16th of October, I will take a marathon session where we will discuss the important topics. So now there will be no Finance 360. You can start revising now. Focus on your revision of the topics that you have done till now, as well as on 16th of October, whatever topic is left out, that also we are going to discuss in the revision session itself. Okay. So this is it. Thank you very much